Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis, Tuesday, September 2nd, 2014. Welcome back from the Labor Day holiday weekend. And we're not really back in full swing yet, but we're getting ready to be back in full swing. So last week, the markets did exactly what we said they would do. They closed around 2,000 on the S&P. They closed up into the holiday weekend, and that was the end of it. And now today we have the normal first day back, kind of low volume day, which is, they call it a hangover day, whatever you want to call it. Basically, you're probably going to have a slow start to the week. Probably tomorrow's going to be much like today unless something crazy happens. And then later on in the week, you have Thursday, where you have the ECB and the Bank of Japan coming out with their monetary policy. Now, what that's going to mean is you're going to have the market expectations, and then the news comes out and the reaction off the news. So what we have is the expectation that those two institutions are going to continue keeping an easy monetary policy. So that's what the market thinks is going to happen. Anything short of that would probably jolt the markets a little bit, but we'll see how it unfolds. Anyway, you're looking at a daily chart of the SPY, and basically you had, let's go flip over to the 10-minute chart, because you basically had a down move early in the day, okay, and then you basically floated back just about to the even line, and it ended up to be a nothing day. Except for, and I know the title of the video was why was gold down, so I'll address that real quick. You know what? Let's flip over to gold, because it's worth talking about early tonight. Here's a 10-minute chart, just gapped down at the open and kept going. Here's a daily chart, okay? Now, gold, the reason I entitled the chart today, Why Was Gold Down, was because I couldn't help but hear the pundits on TV talk about why gold was down. I heard our favorite Dennis Gartman out on CNBC today. He always comes up with a couple of doozies. Oil was down today because there was a couple of tankers floating around looking for buyers from stolen Iraqi oil from whoever's stealing the oil. I guess it's ISIS or some related group. And they're looking for a buyer, so there's a flood of oil on the market. Therefore, the price of oil was down, and gold just followed along. That's what he said. Now, what does gold have to do with that story, and what does that story have to do with the price of oil? He's trying to tell us that two oil tankers drove down the price of crude oil almost $3 today? I don't think so. So there's something else at work. It's deflationary. It's the participants in the oil market pushing the price lower because they believe it belongs lower. It's not because two oil tankers floating around looking for a buyer. Nice try, Gartman. Anyway, I've been, on the we're going to buy gold GLD at the 122 level, and, we're getting closer. But now, let's flip back over. I'm going to just work back and forth tonight a little bit. Let's flip back over to the, wrong chart. I'm going to flip back over to the SPY, and now we're going to talk about what to expect going forward a little bit past the first couple of days of this week. So you may get some volatility on Thursday and Friday. You have ECB, Bank of Japan, and I think you have a jobs number coming out on Friday. That's certainly susceptible to whipsaw the market around those three items. And then next week, you have another turning point in the market. Okay, it's basically the beginning of next week. Expect a turn in the market. Expect volatility to pick up in the market. Now, to what extent, we don't know until it begins to happen. But that's my expectation. So my expectation for the members is we're going to begin building some positions this week in anticipation of volatility picking up next week. And I would caution everybody out there that if you're holding stocks long, if you're holding, long side of indexes or long side of stocks, just begin thinking about protecting yourself, because we are coming into a turning point in the market, and my expectation is that we're going to turn down. Okay, I could be wrong, and it could go the other way. It could accelerate to the upside for sure. But this is my expectation. This is what my work tells me, and this is what we're going with right now. Now, I just want to, on that note of we could go higher instead of pull back, I just want to explain something. I'm going to pick up a chart of Tesla, okay? And we're going to see a daily chart of Tesla, and it's breaking up to the upside. It's probably going to go to maybe not 300, but certainly I like 295. I think it should get to 300. And if that's going to happen, it'll most likely happen in the next couple of days. Now, why is this happening? Now, look at this. It bases here at the highs. Okay, Tesla was at a high to begin with. It bases, and then all of a sudden it starts to break out on Friday, okay? And then it really busts through today. And today there was an upgrade, and then it busts through an upgrade from one of the analysts on Tesla. Then it busted through to the upside, and it kept going. And I just want to explain my thoughts on this. So let's go back to the SPY. Okay. Now, here we are. We're basing up here. Okay. Now, if we get a little bit higher up move, okay, what we're going to begin to do is we're going to begin to run stop orders. Okay. You have market participants, investors, traders that are short the market. Okay. Let's just say we're short the SPY. Any professional trader, any good trader, any disciplined trader, our traders, whenever we take a position, we always have to know what our downside is. So therefore, the traders that took positions on the short side have a stop above the market. Okay? At some point soon, those stops will begin to get hit. And when they begin to get hit, those traders have to cover their shorts. When they cover their shorts, it's forced buying into the market. When it's forced buying into the market, it sends the market higher. Let's go back to Tesla. Let's take a look at what happened. Okay? It bases here sideways, okay? And then all of a sudden it starts to break out. Now forget the upgrade for a second. That's almost secondary. It is secondary. Because what happened is, at some point, Tesla began to run the stops on the traders that were short up here. Okay, maybe 265, maybe 270, something like that. Once those stops begin to get hit, it propels the stock higher because it's forced buying into the market. It's a one-way street. The more buying, the more stops are hit. The more stops are hit, the more buying. It's a revolving door, and what happens is it's called, obviously, a short squeeze. That's what's happening in Tesla, and it's probably not finished yet. Okay, it had volume today. Tesla traded about 10 million shares. Averages maybe half that, maybe slightly more. Okay, it's probably not done yet. All right, let's go back to the SPY. Let's talk about this one for a second. What would happen if the SPY begins to short squeeze? Okay, you're going to first go up, and let's talk about the SPX. The S&P 500 will go to 210. Okay, it'll go to 215, and it'll go to 220. They're kind of halfway round numbers, okay? And they'll go in increments of 5, and the SPY will go to 201. It will go to 2150. It'll go to 202. And, we'll see what happens when we get there. But that's what would happen if some of these stops get run out and there's forced buying in the market. And that could happen if we get some wacky thing occur maybe towards the end of this week, and the cycle that's supposed to come next week, I say market turn, could be inverted to the upside. That does happen from time to time. I don't think it'll happen, but you have to be warned. Traders and investors need to understand both sides of the market. You need to understand your upside, you need to understand your downside, okay? I think we're going to leave it there tonight. There was a big interest rate move today. Well, I'll just flip over there for a second. Here's the 10-year. Here's the 10-year interest rate. spike higher today. This is from an oversold condition. Okay, it's not unexpected. We can certainly go higher. May take a run at 250, somewhere around this 50-period moving average. This is the daily chart, so 50-day moving average. Take a run at this 250, and then maybe make some moves back lower. We'll see what happens. But that was a nice move on the interest rate, but that was long overdue. The interest rates were getting crushed, and that's not unexpected. Okay, folks, I'm David Frost, MyStrategicForecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.